Welcome to Market Profile Part 1. There are 3 lessons on Market Profile in this course. Market Profile is based on a concept that was widely popularized by a man called Jim Dalton, who was a trader in the 80s for the CME. A big part of the Market Stalkers method is using profile to read both intraday sentiment and to see who is making the moves. It is possible to see where the imbalance lies on the day and then to cross-reference that information with the existing supply and demand zones. And that is what forms the second part of the Market Stalkers method. And because reading market profile is a fairly complex subject, I suggest you take your time going through the next 3 lessons, stopping the playback and going back over the parts that you might not be completely clear on. We've created some simplified diagrams throughout this course to help with the process, but please make sure you keep revising. Because once you get to know the profile concepts, there will be a fairly complex flowchart towards the end of the course, and it explains several setups. So throughout the lessons, I'll be adding bits and pieces of this one final flowchart until it all comes down to a complex decision-making process. And then in level 3, we'll continue on to build from there to introduce several more setups that also represent very methodical, systematic decision-making process before a trader enters the trade. Being able to read market profile gives you a lot of confidence in the direction of your trades because you'll be able to accurately read sentiment on the day. And it has 2 functions. The first function is to check where intraday sentiment lies in relation to the previous trading day, and that gives you invaluable information of whether the trend from yesterday is still there. The second function is being able to see clearly who is making the moves. Is it the market makers, who are only really concerned about filling their volumes and getting commissions for those trades, and they don't really care about moving the markets in any particular direction or to any new levels? Or maybe is it the large institutions such as hedge funds, central banks? They all work by positioning themselves for longer-term asset allocation. Both of these market participants require very different levels. Namely, market makers, they will work with whatever is around quite nearby price-wise. Whereas institutions, they need levels that have deep liquidity pools that hold enough units of contracts that are available at that particular price in order to fill their orders that go into thousands of standard lots. Thousands. Which is why it's important to know where the strong supply and demand areas are and where the extremes of swings are, because that is where you will have most of the orders lying. But once you know that, when you're using only supply and demand, the problem still remains with supply and demand is that it doesn't really give you information of the sentiment on the day. Okay? Sometimes there will be a strong looking zone in the middle of nowhere, and that means that that zone is weakened by its location in the previously confirmed swing. So what to do then? This is where the market profile comes in. Market Stalkers method looks for the sentiment to be on the side of your desired trade direction on the actual day of you opening your trade. And in this lesson, we're going to look at some flowcharts that will help simplify this process visually. Market profile comes from the auction theory that in the markets, each participant has a counterpart and that it is a zero-sum game. Market profile is always used on a 30-minute chart. Okay, so you will be looking at a 30-minute candle charts. By trading intraday from a 30-minute chart, it forces intraday traders to wait half an hour to an hour, sometimes even longer, for the entries. and this prevents overtrading because you have no choice than to wait until the profile shows you what is going on. And with market profile, there are two things to look out for. The first one is the value area, and the second one is the initial balance extensions that actually look at a possible day type as it's developing. Day types are coming in the next lesson. But in this lesson, I will only be talking about the value area and the possible scenarios regarding the value area. You know that the market profile has those weird letters on the side. They are known as time price opportunities, or TPOs for short. They are also in the next lesson. They're all a part of the initial balance extensions. But let's go through the definition of the value area first, because it is the biggest topic. Value area is a way to compare the previous day's trading in regards to both time and price, so not just price, but time as well, because how much time is spent around a particular level is incredibly important. Okay? Because the longer the price spends at a particular area, the less likely it is that they want to take it higher. It's very important. The definition of the value area is that it represents 70% of where yesterday's business took place. By comparing the open of a particular exchange, let's say Wall Street today, with where the price opened at Wall Street yesterday, we can quite accurately gauge which side the sentiment lies. And this is the simplest explanation. There are times when the imbalance on the day is too much, and if the price is in the right area when the price extends too far out, then there might be an opportunity for a counter trend trade on the day, sort of as a return to the mean average. But I'm not going to go into that now because doing counter trend trades, the price really has to be in a correct position on the chart. And with counter trends, a trader cannot miss any clues. It involves looking at supply and demand zones, cube points, price action around the area, average daily range, time of the day, and only then you can decide whether a counter trend opportunity is staring back at you. It also requires a very, very calm, organized, secure, and confident trading mind. And while you're honing your strategy and still learning about it, it is best to avoid counter trends altogether. But overall, the value area shows us whether the market is out of balance and how far out of balance it is. As we know, the imbalance in the market is trend. And the balanced market means that every market participant is agreeing on the price. That means there's little to no trade opportunities, especially not with the trend. Okay. Next up, initial balance extensions. In the previous lesson, when we talked about the typical trading day, I mentioned that the initial balance represents the first hour of electronic trading. So that is the first hour of trading when the exchange opens, and it has the most volume, but these days it is also the noisiest period when a lot of inexperienced traders get bitten, get their face torn off, and donate a lot of money to the markets. Once the initial balance is over, we can then start looking for something called initiative activity to confirm the direction of the trading idea. And I've mentioned the time of the day. Time of the day for timing both intraday and swing trades is incredibly important. There are really no successful professional traders who come into the office, sit, and then watch the market minute by minute. Okay? And we've been through the day trading time zones and when reversals usually happen. You should definitely start using these right away as your guides. And if you're trading mainly swing, try to use pullbacks into the desired swing extremes during the New York session. because these have the highest probability of kicking off trends that go on for days. This is not the case with London or Asia sessions, because London likes to fake New York, New York likes to fake Asia, Asia likes to fake New York. It's the game of cat and mouse. So if you enter on a swing during London, it is very likely that you're probably going to get an even better position during New York, because if London moves it down and you're already in a position, and then New York starts and then it moves it all the way up, you're back to where you started. So you're not going to be missing out by not kicking the trade off during London. If you want to run intraday trades that only last enough for a London session, then that's another matter. So keep that in mind. Post NY cut and post New York initial balance. So after that first hour of trading in London, that is 2:30 p.m. till 3:30 p.m. And that is the correct time of day after 3:30 p.m. post NY cut to start looking for your swing trades. Okay, on to the practical application. We're going to see how to start using the value area to start reading the sentiment on the day. But first things first, a trader really needs to know where the value area of the previous day is. We have our Blatek market profile indicator that shows you the value area. You don't have to calculate it, and it makes things so much easier. So please go to my website, menu, products, and then Blatek MT4 indicators, and then you can follow the link to mql5.com marketplace. Alternatively, you don't have to go to the website at all. You can just go into your actual MT4 platform to rent or purchase them. So bring up the terminal window where you usually see your trades, and you do that by pressing Control T if your terminal is not up already. So you press Control T to bring up the terminal, or to take it away. It's a loop. Then you go to step number 2, which is to click on the Market tab. Okay, so you click on the Market tab. And then you can go into, okay, hold on, let me just remove myself. Then you go into the search box over here to the right, and you type in Blatek. That will bring up our products. Then once you click on your desired indicator, there will be this window with options to either buy or to rent it. After clicking one of these buttons, you're going to be given a choice of various payment options, including PayPal, so you can take your pick. Just as a comparison, like we actually charge, for 1 month, we charge like $25. And for comparison, futures platforms charge anywhere from $120 to $500 per month for the same functionalities that our Blatek market profile indicator has, okay? So it is good value for money. With the value area, we're looking at how the market opens today in relation to where the price was at the same time yesterday. So when I say when the market opens, I mean electronic open. So for Wall Street, that is 9:30 for New York, which equates to 2:30 p.m. London. And London actually opens at 8 a.m. London time, which is 3 a.m. New York time. So a lot of you who are in America or elsewhere, you'll probably be asleep. But these times of electronic opens, they also go for Forex markets. Although the Forex markets are open 24 hours and 5 days a week, there is still a lot more volume once the electronic trading actually starts at the official exchanges. So we do not look at the value area across the whole 24 hours. We only use the active trading hours for the sessions to gauge market sentiment. So really, you will have 3 value areas for that correspond to 3 trading sessions. So you'll have a London value area, New York value area, and Asian value area depending on which session is currently active. And this is where a lot of people go wrong with the profile. They kind of get the profile, and then they look at one single value area for the whole of the 24 hours. Like, how would that help anyone? Now, when you have the BlackTech market profile indicator, you can set it to display 1 or 2 sessions to switch between them. We have recently added a Y letter hotkey. So if you press it, you can easily switch between the London and New York session without even having to go into the input parameters. You can set it to display 3 sessions as well, but you should always restrict your trading to maximum 2 trading sessions, because anyone thinking that they can trade through 3 whole sessions in one 24-hour period is clearly not getting enough rest. And you will end up making horrible mistakes due to lack of sleep, and that will cost you an awful lot of money. So another note on the value area. If you try to trade, let's say, S&P during the Asian session, meaning you're trading something, the particular instrument that doesn't usually trade during Asia very widely, and that results in a super small value area for that session. Those value areas will be a lot less accurate, because value areas are based on average distribution of the normal price movements. If any of you have any kind of a quant background or anything like that, or even just a scientific background, you will know what I'm talking about. So therefore, if you have overnight trading or holidays when liquidity is generally very dry, and you don't actually have a lot of trading that goes on, obviously the small value areas are not really usable. So some common sense needs to be applied here. Not relating at all to the number of trading sessions, but there are also 3 scenarios for the value area open. So we're looking at how the market opens in relation to yesterday's trading day. The market can either open inside previous day's value, then it can open outside of the previous value, but still inside yesterday's range, because each session has a high and a low, correct? You have a high price for the session and a low price for the session. But then the value area is a 70% of where business took place. So if it opens outside of value, but still inside the range, that is less of an imbalance, but it's still some imbalance. And then finally, the third scenario is that it can open outside of value, but also outside yesterday's range. That indicates a large imbalance. Scenario 1. This is a little clean graph to show you just the initial idea of scenarios. Like one of the traders said, sort of like value area for dummies. But it's a very good way to explain stuff, because it is a complicated concept. So I figured I should just clean it up, and rather than just throwing a whole bunch of charts at you, I wanted to do something that is very, very clear of what you're looking for. If the price is opening inside the value area, this is largely undesirable for us, and it actually shows you that the market is balanced. Meaning that the market participants are actually accepting the prices at these levels. It rarely means further advancement of the price in the same direction, and sometimes can indicate that a possible trend turn is on the cards. A trader would then have to wait until the end of initial balance to see whether there will be any kind of imbalance that occurs during the trading day that might push the price outside of that yesterday's value for a possible intraday trend. And here is an actual market example of scenario 1. So this part here, this big red circle, is when the session actually started. And markets open, let's say today, and it opens inside value. This is an indication of the prices being accepted. And sure enough, look at that, for a number of for a number of candles after that, prices just went absolutely nowhere. So opens inside value are largely undesirable. Scenario 2 is when prices open outside of value but still inside yesterday's session range. So these dashed lines represent session high and session low price-wise. So should the prices open outside value but still inside this range from yesterday, and remember we only ever use previous day's value. Current day's value is no use. Current day's value, if you're going to look at the developing value area of today, it's subject to change. It's like a candle that hasn't printed yet, which is why current value, it means nothing until the markets close, and then you can read it the next day. So do not use current value area to gauge sentiment. That's not how market profile works. You always use the previous day's value for that. So if the market opens outside value but inside range, it means that the market is only slightly out of balance and might offer good opportunities. It might, okay? Because this is what can happen. Like this is your session high, and session low is sort of here, that is very similar to the value area low. So we open just slightly above the value area, but we're still inside that range. And then it just goes. So it can actually kick off trends, you know. And here is another example, but there's a bearish version of the same thing. So you have a value area, here you have yesterday's session high. Once again, this session high is kind of almost the same as value area high as well. And this is yesterday's session low. And you get an open below, because this is your open, and then it tests the value area low, and after a while it finally goes. But in this case it also took a hell of a long time to get anywhere because the imbalance is not that big. Finally, scenario 3, which is open outside of balance and outside of range. When the price opens outside of value and outside of range, there are a couple of things to know. The first one is, should you get this, this does technically represent the most imbalance. It can offer the best conditions for an intraday trade, even for a swing trade, timing-wise. And even if you never want to look at intraday to trade it, you can still watch the profile opens for the best possible timing of your swing trades to make sure that on the day of your swing trade execution, you're not against the imbalance. Because in that case, if you are against the imbalance, it is likely that you are completely wrong on the direction and the trade has little chance of working out. So knowing what to look out for timing-wise on the profile, it will actually help with accuracy for your swing trades. So outside of value, outside of range, here is what that looks like on the actual chart example. Now this is a crude oil chart, so you really can get excellent momentum trades from this as well. I mean, this is a pure breakout trade, you know, but this is how you do breakout trades. You can do them from the profile. However, caution is required. So I said there's two things to know with scenario 3. Well, this is the second thing. Caution is required when the market opens vastly outside of value and outside of range, and it's exhausted the ADR for the day. That likely means that there is no trade there. Unless you really know what you're doing and the price happens to fall into a medium-term swing area and then starts to print a reversal. In that case, that is a counter-trend opportunity, but please avoid counter-trends until you get consistently profitable with the trend pullbacks into Q points in swing extremes. If a price reaches the swing extreme on medium and larger time frames and you're still somewhat inexperienced, it's best to just sit it out and observe what happens and write it down in your journal. So track it through forward testing. You might even want to wait. If you do want to trade counter trend, you could wait until the medium time frame actually confirms that trend change. If you remember the rules on trend change from the Market Stockers Level 1 course. And then once that trend change happens, then you can trade the counter trend on pullbacks, because there's a different information in the markets then that you can use in a safer way. Okay, this is what I was talking about when I said that if the market opens too far out of balance and too far out of range. We have the open out of balance, okay? It's all the way down there, but what happens? It migrates and goes back to mean average towards the value low. So be very, very careful. Very, very careful if something has already exhausted the average daily range for the day, and then you get a Wall Street open or a London open. Okay, very, very careful with that. Next, timing swing trades for trend turns. Let's say that you have a supply and demand zone that you're looking at and you're not sure whether it's going to work or not, whether it's going to be reactive or not. A trader can use the profile to see how price opens at a particular exchange time that they're looking at, and then to see what kind of sentiment is looking back at them from the chart. If you're looking too long, ideally you want to see prices open above the value area, because that shows a change in sentiment. If something has been falling, and the value areas are here and market keeps opening below the values, well, by the time you fall into a particular swing extreme and then you get an open above value, that's a change in sentiment. So in that way, it's very logical. There is another thing that's called responsive versus initiative activity, and it relates to those two market participants from the beginning of the lesson. So it relates to whether it's the market makers or whether it's the institutions making the moves. And we'll learn a lot more about them in the coming lessons. But for now, if you want to go in on a swing long, you want your value area open to be bullish for New York, for example. If you want to short it, then you need an open below the value area. Okay? So hopefully that makes sense. For swings, the rules for Market Stockers Level 1 still apply in regards to the chart position, obviously. So your swing trade idea still has to come from a medium or large time frame Q point. And the zone that you're looking at, it still has to have a profit margin of about 5 times risk reward. So with that in mind, we can conclude that your decision process should look like this. Okay? So if you have a demand zone you're looking at, and you are in a daily or H4Q low, the value area open that you're looking for needs to be above the value area for your long trade. Should you get a value open inside or a value area open below, it's a no trade. Okay? So this is how you would time your swing trades through market profile, using a demand zone for a long. Now, in case the price moved away from your trade location, let's say you reached the demand zone and price moves away, and the trend turned, let's say, while you were sleeping, you can still try to go in on a pullback, and this is where a confluence of value area high for long trades and a brand new conterminous line from a 4-hour chart would come in. And here's how that will look like as a decision-making process. So you still have that demand zone. You still have the Q low. You would still get a value area open above. However, now because the trade location has gone away from you, you then look whether you have a confluence of the 4-hour conterminous demand line around, at, or somewhere above value area high. If you get that, that is an automatic limit order. Okay, so the previous chart dealt with you actually being there and watching stuff happen. This one is if you've already missed it and you come in and you have a 4-hour conterminous demand line newly formed, and in that point, if you're aiming for a swing trade, it really doesn't matter whether the new demand actually has 3 to 5 times risk reward, because you're taking it off a larger swing trade. You've taken it from a demand zone and not from that area. You might be using this area to get in on a swing, but your profit margin was still taken from this, from the demand area. And this is a chart example of what I'm talking about. There's a larger time frame demand. All of this is a demand, this thick blue line, but it's a weak demand. So we don't know whether it's going to turn or not. So we need market profile. So we are inside a whole area of a weekly Q low. So we're kind of waiting for the turn. We're waiting for the turn. Finally, we fall into the larger time frame area and we get a confident open above value. And we now have a brand new H4 demand with a brand new conterminous line. And this is your London value area. And this is the London open. So now we can trade the pullback into the new conterminous line and use that as a bounce to get in on a swing trade. And you've timed your swing trade. Okay? Because look at what happened before. You still had some bullish opens happening here as well, but they kept failing because you didn't have an actual conterminous, nicely looking conterminous price agreement demand line that you can use to get in on it. And some of these also kept opening inside value as well. And then this one opened below value, which was like disaster. But finally, 3 days later, you get your signal from the market profile. Okay? So I waited until the prices opened above value confidently, and then I placed the limit order when I saw the confluence of the conterminous line of the newly formed 4 hours. And that is an offspring zone. Okay, we now have an offspring zone. And it was located just above the value area high. If you don't want to use this entire H4 zone for a trade, another approach would be to watch it and then to wait until the prices arrive at this conterminous line of the H4, and then to drop down to a 30-minute chart and look for either bullish engulfing or consolidation or even morning star formation, so any kind of reversal pattern on the M30. And then you would use that for a smaller stop that would bring you the 4 times risk reward target quite soon, usually within 12 to 24 hours. And then also, if you do wish to hold it longer, it would be possible, but you have to make sure to keep an eye on the next profile of the session that you use to enter the trade, because, you know, obviously if you have to enter through the London, then you have to use the London value to see if the prices are still opening above value. If you use the New York session for the bullish open, you have to see tomorrow whether the price is still opening above value for the New York session. So don't mix up your sessions for swings, okay? Compare same sessions that you use for entries. You have to be patient. You cannot hop around too much while you're waiting for the trade to work out. Once you get that signal on a lower time frame chart, you should then watch it until the end of the 4-hour candle, and then continue to monitor the 4-hour candle closes. Because if you're still going to use a 30-minute chart for a swing trade, you're going to freak out at any kind of bullish and bearish engulfing if you're in a long trade. So you might take the trade off too early, and you don't want that. So the way around it is to get in on a 30-minute chart and then go up to an H4 chart and just wait to see what happens. And there is a whole lesson on trade management in this course, so we'll get to that in due time. And please notice that I do not say stuff like value area longs should be done from value area low. That's a good reason why I don't say that. I say longs should be done off value area highs, like this is. This is your London value area high. You do not want the price to accept value, okay? If it does, that's a very, very bad sign, okay? It is important that the price on pullback tests the value area high, even test the value itself, but as long as the 30-minute candle doesn't close inside the value, it is still a bullish setup. And okay, this might sound a little bit unclear and jumbled right now, but not to worry, I'll be breaking it all down very, very soon as to when, how, and why this particular acceptance of value is either desirable or undesirable, and we will go through it, believe me. So just for now, make sure that you remember for long trades, you want to go in off value area highs. For short trades, you want to go in from value area lows, okay? We cannot go from inside the value. Okay, so here is another flow chart for basic market profile decision, swing trade timing through market profile. It is exactly the same thing as we had for the demand, but we now have it for the supply zone. So you have a supply zone that has to be located in a daily or an H4Q high. You will then look for value area open below during Wall Street, okay? If you get the bearish value area open, then you have your short trade. And same thing for the short trades. If the location of the trade has gone away and you still want to get in, so you would have a supply zone that is inside daily or 4-hour Q high, and you get a value area open that is below the value area, meaning that it's a bearish signal. If the price location is not there, you will be looking for a confluence of the new conterminous supply line below around value area low. And if you get that, you can place a limit order. And same thing, if you don't want to use a 4-hour chart, you can then wait on the 30-minute chart until the prices revisit that conterminous line on the H4 or sometimes even the daily chart that matches the value area low, and then you would watch for market reactions on the 30-minute chart. Okay? Okay, that is it for the flow charts, for the timings. Now we're moving on. I'm gonna talk, like I mentioned, value area acceptance, okay? So what is that? It neatly brings me to a possible condition that Jib Dalton himself calls the 80% rule. However, the 80% rule isn't really automatically an 80% rule because there are so many factors that determine whether this particular market behavior will be relevant or not. So let's first go through what actually is the 80% rule. It's a sort of a scenario that depends on price opening outside of value, but then proceeds to meander towards the value. Then it enters the value area and closes a 30-minute candle inside it. So let me say this again. The market opens outside of value area and then it moves towards, so let's say this is your value area, right? That's your value area. So market opens lower, for example. So that's a bearish open. But then market proceeds to meander upwards and then comes up to the value area, penetrates the value area, and closes a 30-minute candle inside it. Okay, so that constitutes an 80% rule. Once you see this happen, should the market conditions and chart position of the price be at a favorable location, then there is an 80% probability that the price will rotate through the whole of the value area all the way to the opposing side. 80% rule can technically happen at any time of the day, but as a general rule, the earlier in the trading day it happens, the more likely it is to work out. So to recap once more, 80% rule states that should a price open outside value and then at any time of the session proceeds to move towards the value area, ultimately penetrating it and closing a 30-minute candle period inside the value, it is highly likely that the price will then continue in the same direction until it tests the other side of value. And here is a simplified graphical representation of the value area acceptance. Is a textbook example. So here market open at Wall Street happens outside of value, and then it proceeds to meander towards the value, and imagine these are 30-minute candles, and then it closes a candle inside it. So this is technically an 80% rule. Now, back in the 80s, when the market profile was first invented, markets had a ridiculous amount of liquidity compared to today. And Dalton 80% rule states that you need 2 30-minute candles to close inside it. But I mean, today with relatively small value areas we have today, due to the decreased liquidity, sadly, by the time that you wait for a second 30-minute candle, the opportunity is gone. So I've actually modified this rule based on my own experience, and it is enough if the price confidently only closes one candle inside value. And when I say confidently, I don't mean like this. Okay? This example could be just a test of the value area high before the market rejects it and continues higher again. So confident close inside the value is required. Here's an actual chart example of S&P closing that 30-minute candle inside the value area and then proceeding to move towards the opposite side of value. Okay? So it closes it, and very soon after that, it just goes. I mentioned that there are certain factors that need to be present in order for this 80% rule to actually be 80%. It really depends on where the price is in relation to chart positioning. It also depends on the prevailing trend. Time of day is also a component. Instrument that you're trading is a component. And finally, whether there's congestion inside the actual value area. You might get congestion in it, and then it's going to put a stop to price going through it in a timely manner, if it goes through it at all. So let's start with chart position and underlying prevailing trend. Couple of rules here. If the price is outside of swing extremes, therefore middle Qs, so not in Q highs or not in Q lows on a medium time frame, they're in the middle of Q points, then always only go with the current prevailing trend. And if you remember the rule from taking trends, we need to take the trend from 2 out of 3 medium time frames, okay? If you're unclear of the trend rule, please go back to level 1 course and revise the lesson on supply demand as trend indicator. If you only bought level 2, I really suggest that you access the individual lesson on the trend and we do have a section on the website called Lessons on Demand. So you can go there and you can buy the individual lessons. If price is inside the Q points, extremes, and the value area acceptance happens against the trend, then you can take the value acceptance as valid. Okay? And we'll go through some of these. The next one, next condition is time of day. This rule will depend on whether or not you're looking to trade Forex or equities and commodities. If you're trading Forex instrument, liquidity dries up pretty much the later in the day it gets, especially once the European markets have closed. Unless it's a safe haven correlated currency, such as kind of USD yen or Euro USD, and both of which are today correlated heavily with equity markets, so much that they have a direct negative and positive correlation with the equity indices. And for equity markets, that last hour and a half of the trading day is quite lively, like as you know from the typical trading day lesson. So really, if you get a value area acceptance on S&P or on crude oil quite late in the day, that is a perfectly valid signal. Next up is that there cannot be any supply or demand, so no congestions at or inside value area. If you have an opposing supply-demand area that overlap the value, unfortunately that is invalidating the 80% rule. And this is what I'm talking about. And this is where the combination of supply and demand and the market profile actually comes in. So you have the prices that have moved back, as you see on this chart. It is value area acceptance, very confident. But everything is wrong here. From the chart position, like we're clearly inside some kind of a swing extreme here, and there's so much congestion inside value. Like if you, this is the same chart, so if we just point this area out for you, I mean, look at this. This whole supply here, that is like bound to put a stop to price advancing to the opposing area. So this kind of a setup would represent an invalidation of the value area rotation rule because you have a supply in the way. So make sure you're aware of where your 30-minute and 4-hour and also daily supply demand zones are and their respective conterminous lines, how they're located in relation to your value area that day. Okay, on to the practical use. Here is a chart of Eurodollar. And just analyzing the chart quickly, this whole top area was inside a daily Q high, meaning that by the time price reaches a daily Q high, you're already expecting a move down. But because there are no strong supplies, it was tricky getting in. Enter 80% rules. This is how you would use it. With price accepting the previous day's value area, I was able to find an intraday trade that enabled me to take a short trade and to run it down to first available demand, enabling me to get a 3 times risk-reward trade. The actual way you would play these, you would take the size of the 30-minute candle that is closed inside the value area. The stop will always go above this 30-minute candle because a lot of the times price has already moved away from your initial intended supply area. But you will only use this setup if the stop is small enough to be optimized for an intraday trade, meaning that you cannot use a 40 pip stop for an intraday trade on something that normally moves like, let's say, 100 to 120 pips in a day on average. In Market Stalkers Level 3, we do go into optimizing stops for intraday trades, but for now, again, because it's quite advanced, let's leave that alone. So textbook entry and stop when 30-minute candle closes inside it, you use the 30-minute candle to place your stop. But please also be aware of how far your opposing value area level is. It still has to have a profit margin between 3 to 5 times to make it a valid trade. If I go back to this chart, in this particular case, because the stop required would be way too big, so I would barely have even a 1-to-1 trade, you would actually use a possible pullback to a value area high to get in on a trade, because these do happen sometimes. But you know, generally I don't like to go in of value area highs when the price is already inside it, but this is the exception because we're talking about the acceptance of value here. Okay. For more crazy instruments like S&P, crude oil, yen pairs, you really have to think quite fast once the candle closes inside. You have to have a scenario already of which direction you want, and then you also need to already know what you want to see. You need to start visualizing the outcomes of what you want price to do, and then when you see the price doing that, you already know what to do as well, okay? Long before it actually happens, but you've got to be prepared. So in this case, because the case was a little bit too high up and inside a Q high, I knew I wanted to short. And then I wanted to close inside value to confirm that. And once I got that, I already knew where my stop would be. But because the price closed a little bit too far into it with a large candle, I had to make up my mind on the entry. At market or through a limit order. And this one was a limit order on the basis that we might test value area high. Another way to play it is to wait for another sort of hour and a half after this happens. But again, in that case, you run the risk of missing the value area acceptance rule altogether, and especially in like fast moving instruments. So really going back to the simple chart over here, this is what you want to see. You want to see a decent sized value that doesn't have any supply and demand areas that are overlapping it. So the path through the value area needs to be clean. So make sure that on a 30-minute chart and a 4-hour chart, you don't have any conterminous lines or demands or supplies that are in the middle of it. In this case, because we're shorting, we don't want any demands in the way, because that will mean a possible reaction from that conterminous line. As long as you get anywhere between 3 to 5 times risk reward, it's a valid setup. So stop goes above the candle that closed inside the value. Obviously, if you manage to get a good profit margin from the recent high or a low if you're going long, then don't nitpick on the stop size. You don't need to use one candle. But usually what tends to happen with these is that by the time that value acceptance happens, the price already would have moved away from the zone that you were initially looking at. So the stop required would be too big. It would be like somewhere up here. But once you have the clean view of the opposing side of value, the momentum should take you there quite quickly, okay? If it doesn't, and you've waited around for 3 to 4 hours, it is time, to kind of come to the market close, then just close the trade and recheck that you haven't missed maybe a higher time frame conterminous line that is stopping the further move in the same direction. But definitely take the profit and then reevaluate. Okay, on to the final scenario in regards to the value area, and that is value area rejection. This pertains to a condition when the price opens inside value of the previous trading day, obviously, and then proceeds to move outside it and closes a 30-minute candle outside value. What this indicates is that at the open, price was balanced. So price has spent time in the same area, and that area has been accepted as a price agreement. Every participant agreed that the price is either high or as low or as high as it needs to be, okay? And they're like, this is where we need to be. However, perhaps you have a release that comes in that was unexpected, and maybe some new numbers, somebody speaks, one of the Fed members, and then the price proceeds to move outside of that balance, outside of the value, to create a new imbalance. And what is imbalance in the markets? It's trend, okay? Now, in an ideal setup, as the price is rejecting the value area, you'd also be getting the initial balance extension in the same direction of the rejection of value. So for initial balance is the first hour of trading, okay? So when you get to that third 30-minute candle, you would then look for it to go higher or lower than the other two, okay? So you would look for prices to come out of the initial balance range. So for example, on this slide, you have price that opens inside value, okay? But over the first hour of trading, and that's these two candles here, that's the first 30 minutes, and this is the second 30 minutes. Two 30-minute periods, so these two candles here. Once the initial balance is over, you now have a condition where the value area was rejected early in the trading day. Now this instrument was in an uptrend at the time, so this was just a pullback into the first available conterminous line. But when the Wall Street Open came, the prices were inside value. Okay, so we tested the conterminous line, but we were still inside value. And then we proceeded to reject the value, and immediately after that, it extended the initial balance to the upside. So what you're looking for here is a continuation setup on a pullback, okay? So reading the profile isn't just for catching overall reversals. It also enables you to do these like breakout trades with the trend and with the momentum, and especially if the price isn't in the swing extreme, but it's in the middles. So this is how you would trade the middle. You would trade the middle with a trend, but in the direction of the prevailing trend with the help of the value area. Let's say you're in the middle Q points and you're not sure what's going to happen. On this profile, it's clear as day. A pullback into the first available conterminous line, which brings the open inside value. And then by knowing where this kind of fair value of yesterday trading was, you can clearly see the intent of the market participants to continue the underlying trend. So that's firstly through this value area rejection that gives us the imbalance, but then also through the subsequent initial balance extension, which happens in this next candle as a follow-through, okay? Now on this chart, it shows you why you shouldn't go against the trend when the price is in the middle of Q points, middle of nowhere. This particular instrument is in an uptrend going towards its Q high, okay? We get an open above value. That's the open, okay? That is the candle that opened over here. And then we get an acceptance of value that is against the trend without reaching the Q highs first. So since the price is not in a swing extreme, you get a lot of rejection wicks here. Look at these. Look at the way they're created. And then you get a consolidation that's inside value, failing to reach this first demand that is really located in the value area low. So we have a classic value area acceptance, but because it's against the trend and not coming from a swing extreme, this is not a valid value area acceptance. So in this case, no swing extremes, it's an invalidation of an acceptance of value. So you have to wait for your trading plan, which here would have stated something like Q high, long way away, will only take signals from the profile that are with the trend until price reaches Q high. But once price once again rejects the value after this consolidation, that is your valid signal. Okay? So you will be able to run a little long trade that day. Now, since we're talking about value area acceptance and rejection, here is how you can use these to see whether the price will turn at a particular swing extreme that you're looking at. If you're not sure, let's say it's a weak supply like we have here. So we've had some reaction, but we still need the profile to confirm. Sometimes it's fairly clear cut, like this one here. So price reached the supply, which happened here, and we're simply looking for a signal on the profile that will give the turn, either in the form of a bearish open at Wall Street, which is what happens here. Okay. Once you have that bearish open, you will still need a trade location. Okay. You cannot just get a bearish open and just go, I'm going to short it, because a lot of times it's not what happens. It needs a reference area. Opens either below or opens either below or above value will give you the trade direction, but you will still need a confluence. Okay, so this is why I say that the profile shouldn't be used for trade locations. So I would be looking for some kind of a congestion. So we have that here, which is inside an H4 Q high. Okay, so we have a swing extreme Q high here, and then we also have a confluence of value area low. So now, because of the bearish open, we're no longer expecting to go with the trend because we've reached the end of the line, at least for now. Once the train arrived at its intended destination, you're not going to be buying a ticket to reach the same destination when you're already there, unless you have a serious issue with like understanding how things move from A to B. So this H4Q high, that's a swing extreme. Therefore, any acceptance of value at this point will be automatically invalidated by the chart position. And if I go further into the detail and analysis, there's also supply here. It's a cluster of things that is going on inside value. Therefore, the path to the opposing side isn't clear at all. So take all of that, take the chart position from the H4Q high, take the supply, take the already the bearish reaction that we've had previous to this whole thing happening, take the Wall Street open below value, and what you have is one really confident view that this will turn somewhere here. Okay? So now the trade location obviously becomes somewhere around this congestion, the first congestion that is newly formed, that becomes a trade location. Okay, so that becomes my ZOE, it becomes my zone of interest. And then if we look about 4 hours into the trading day, we get that test of the supply because this is where it opened. So as soon as you get a bearish open, there's a Q high, we've had a supply, so we had one rejection of a higher time frame supply, and then we've created one more supply around New York value area. So my trade location will be either around this Q high or around this value low. Sure enough, I get a consolidation followed by bearish engulfing. So this is a phase 3 on a 30-minute chart. That I can then use to run my intraday trade all the way down, and it just goes. So what I've done there, I've managed to time the market turn through the use of the profile to get a very small stop that enables me an optimal trade location for the swing trade after I saw the initial reaction. And there's no need to use massive stops that are usually required to trade from 4-hour and daily charts, never mind weekly charts. So that's an example where clear bearish open on the profile shows a sentiment, and then we've used the cluster of the supply on both the M30 or an H4 chart that overlapped the value area low to enter a trade position from a swing extreme. Okay. Now here is an example of using a value area acceptance in order to time the swing trades. Price here, where we are now, is also at the swing extreme. There is a weak supply around these levels, so you're not sure whether the supply and demand concept is going to work out if we only were to use supply and demand. So if you're trading supply and demand, you'll be trading blind. You don't know what's going on. So the Wall Street Open happens to be, this is your value area from yesterday, okay? The Wall Street Open actually happens above value straight into that pre-existing supply. That is normally a bullish signal if something opens above value. But because the price is inside a swing extreme, I want to see a value area acceptance all the way down here before I'm sure that my swing trade is going to work, okay? Sure enough, acceptance of value happens and it's there, and then price just jumps off a cliff. Now in this case, if you're looking for a swing trade turn, you still do need to make sure that the value area is clear of congestion. But because you're taking your profit margin from a much larger swing, you don't have to make sure that the distance to the opposing side of value has enough profit margin, because this setup only really applies to intraday trades, since intradays need to be optimized with stop sizes in order to get the 3 or 4 times risk reward, right? But if you're running a swing trade, that becomes completely irrelevant. So you can actually run a very, large stop as long as that falls into the profit margin of the larger time frame that you're looking at. So in this way, you're only using the 30-minute chart and the value acceptance to time your swing trade, just to make sure that we've turned. But also on this chart, if you look carefully, we have a phase 3 on 30 minutes, followed by value area acceptance. So that's a clue too. Now, I would like to address a very, very common issue when people first start trading with a profile, and that's longing and shorting from within the value areas. Once something has accepted the value and is already going through it, it means that the market participants are accepting those prices. Now, depending on the chart position, again, this will either mean a continuation of the underlying trend or a trend reversal. I have trained quite a few traders now, and once they start using the profile, almost each one came up with an idea to short from within value, to short from value highs, and to long from value area lows. But these two ideas are very low probability setups. We've actually coded up a quick algorithm to see whether we could do anything with these value low longs and value high shorts. And the algorithm results were really atrocious. Like, we got like a 20% hit rate. Just doesn't work. So stay away from these. No longing from value area lows and no shorting from value area highs once the price is inside value. And that pertains to the opens inside value, obviously. Like value area acceptance, that's a different matter, because you're coming from above and then it accepts value. So when the price opens inside value, or it accepts value, like for example, because everything needs to be done through practical examples. So for example here, if you're looking for a short here, and then you want to short the high, that's fine because we've accepted the value. But it is not fine that once the value has been accepted, that you try and long from value area low, okay? Same thing here. If something has already accepted the value and you're looking at a cluster of things, don't try and short it off value area high, because that's accepting the higher prices and it's likely going to go all the way through. If this happens and this congestion breaks down and the price indeed reaches the value area high, then you have to see whether there's a higher conterminous line and wait for another day to see whether it's going to react again. That's an invalidation. So do not long from value area lows and do not short from value area highs. Let me see if I can get another example. Okay, here we go. So this is an open inside value. Now we know that here we had a rejection of value. But I have a lot of traders going, well, this isn't like going down. So we've had an open inside value. I'm going to try and short it off value area high. No. That's not a setup. That's a super low probability setup, the worst you can think of. So keep that in mind. The final thing I want to mention about the profile part 1 is something that will tie into the next lesson, and that is the existence of point of control, POC for short. Now, point of control is sort of like the fair value of the value, right? It represents kind of the middle of that distribution for the day, much like you have the distribution on like peaks and troughs as the price is moving. You have the distribution curve for the value area too. That's what the value area is based on. But point of control, it represents the middle of the distribution. If you see these letters on the profile, these weird things on the right hand side, we will learn about them in the next lesson, and they will always have that distribution curve, the little belly where the price spends most time. I also need to advise you that POC, point of control, is not a valid key level that you can try and run trades from it, because it represents the middle of the middle. It's a balance of a balance, okay? Usually POC is deep inside the value, meaning that in order for the price to reach it, it has to accept value first, meaning that unless you're coming to a swing extreme, the price will just keep going, okay? With that, that is it for one mammoth part 1 of market profile. The other 2 lessons coming up, they're still challenging, but they're not as difficult as this one. Once you start getting accustomed to the meta language, this new terminology of the market profile, you should be able to understand it a lot better. Like I said before, I suggest that you take time with this part 1 to really understand every single concept from this lesson. Ask me questions, email me, make sure that you're not confused with any of this foundation of market profile, because it will only get harder from here on out. The next lesson is about date types and about TPOs, the letters of the market profile, what they are and how you can use them. So thank you for watching, and I'll see you for the next lesson.